Hi, this is Todd Baker, your certified mortgage planner, and in this video we're going to discuss why mortgage rates change. And we're going to start the conversation by discussing two myths. Basically, they're widely held beliefs on what impacts mortgages, and both of them are wrong. The first one is the Federal Reserve controls fixed rate mortgages. The fact is the Federal Reserve does not control fixed rate mortgages. When you hear that the Federal Reserve has changed interest rates, that doesn't mean that mortgage rates are going to change. They're not tied whatsoever. The second myth is that the 10-year U.S. Treasury determines mortgage rates, and that is also a myth. They are not tied together. However, mortgage rates tend to follow a similar trend line as the U.S. 10-year Treasury bond. What does determine mortgage rates are what's happening in the bond market. In Chicago is a place called the Chicago Mercantile Exchange, and it's similar to the New York Stock Exchange, but instead of trading stocks and equities, what they call it the equity market, the Chicago Mercantile Exchange trades bonds and commodities. So what's traded there is gold, silver, soybeans, pork bellies, and also bonds, U.S. Treasuries, junk bonds, corporate bonds, and mortgage bonds or mortgage-backed securities. And the direction of that market and the direction of the actual mortgage-backed securities, that's the direct correlation to fixed rate mortgages. So what's important is to understand that if you've gotten a quote, either if you're a buyer or you're a refinance, know that that quote is just a snapshot in time of that particular moment where interest rates are at. And that if you just looked at the internet, understand that the internet is going to show you the pricing with a super high credit score and paying what's called points, which are prepaid interest, so that the advertised rates always have the lower interest rate so they can just get you to call. Because your actual interest rate will be determined not by the movement, just by the movement of market, but by credit score and other factors. And I've done a different video on that. So what's important to you as a consumer, as a homeowner or potential homeowner, is working with someone that knows what they're doing. So this is an actual chart of the mortgage-backed securities. I subscribe to this. This is not available to the public, and it actually shows this chart. As you can see, as you look at this chart, you can see how these candlesticks go up and down. When they're going down, that means mortgage rates are getting worse. When they're going up, that means mortgage rates are improving. And you can see these. There's a red line of resistance and green line of support. There are technical analysis that I understand how to do to determine should we lock or should we float. And then I also get the daily news and then the economic calendar that shows what's coming up and what's a high impact and what's a low or moderate impact. So you can see the payroll is always and this is this Friday coming up, for example. In this particular instance, payroll's coming up, and that's a high impact event. And so why that matters is there's a lot of loan officers that have a very bad habit of, you get under contract and they've quoted you a certain interest rate, and then they don't pay attention to the market. They don't have these tools and they don't understand how to use these tools, even if they do. And so they float your interest rate instead of locking it. And what happens if you had a really good interest rate and the payrolls hit up, and let's say your interest rate was 4%, and then the payrolls come out and the rates worsen and it goes up to 4 1/8 or 4 1/4, you end up paying a higher interest rate simply because your loan officer wasn't paying attention to the market. So that's how it works. If you have any questions, please feel comfortable reaching out to me, and I hope you have a great day.